Let me introduce our panel. We are so honored to have Commissioner David Altmaier from Florida. Anything to do with insurance, really globally, David's involved with. If you strip out all of the EU member states and strip out all of the U.S. Individual states and just treat everyone as a market, David regulates the 9th largest market in the world in Florida. Of course, it's a very important state for us, and so we're thrilled to have David. He is now Vice Chair of the International Association of Insurance Supervisors. He's leaving here to go to that annual general meeting and have some of those capital discussions. So, David, thank you for being here with us today.
Of course. Thanks, John.
Let me introduce Barry Gilway on my far left. Barry's the CEO of Citizens Insurance in Florida, the largest residual market in the U.S. for property. At one point in time, I think you had 70% of all the residual market property policies in the U.S. So thanks for joining us, Barry.
Welcome.
Yeah. And then Angela Azare, thank you from RenaissanceRe for joining us. Angela's a rising Bermuda superstar, and she knows more about modeling and cat risk, and she's responsible for helping RenaissanceRe with tools and products and markets of growing their business. So again, we're continuing that theme of growth. And we're gonna go right into private flood and the potential there. And David, you're doing some great work in Florida and we should lay some groundwork of why people need to know about this shift to private flood. But let's turn to you and tell us what you're doing in Florida and why.
Sure. Well, thank you, John, for the question, and thank you for the invitation to be here this morning. It's always a real treat for me to come to Bermuda and interact with the Bermuda market that's been so critical to a lot of the progress that the Florida market has made, especially in the property arena, and as we'll talk about on the panel, in the flood space as well. So thank you for the opportunity. We are very focused on the development of the private flood insurance market, and it's really for the reason that when you look at the Florida market, you look at the number of people who think about flood insurance risk down at the consumer level. It's a very low number of people that are making that step to buying flood insurance. And you can look at some very heartbreaking statistics when you look at storms like Hurricane Irma, Hurricane Michael that impacted Florida. It's a nationwide problem in the U.S. You can look at storms that have impacted Louisiana, Texas, and the Carolinas. There's a very, very low take-up rate for individuals that are purchasing flood insurance from the NFIP. So our biggest motivation is how do we close that protection gap for Floridians? How do we get more people in Florida thinking about that risk and taking that step to purchase it? The answer that we have found, one of many answers, is increased participation in the private flood insurance market. As we have had conversations with our counterparts in DC about the reauthorization of the NFIP and challenges that exist with that, we kept hearing a clamor both from the direct market and from the reinsurance market that we are ready to write flood risk. This is a risk now that we think that we can do. There's just some hurdles that we think we need to take out of the marketplace in order to open the doors for that. So we've been working with our Florida legislature. They've been very embracing of the notion of private flood insurance. Senator Jeff Brandes in particular has been a strong advocate for private flood insurance. And so we have passed some Florida legislation that has allowed for the development of flood insurance CAT models by our Flood Insurance Commission. We have passed some things that make it easier for private carriers to come in and offer that product both on an admitted basis and on a non-admitted basis from a form and rate standpoint. And we've seen some pretty remarkable progress. I think the last numbers that we saw, we had upwards of 40,000 policies were insured in our private market at this point in time. But when you compare that to the number of homes that are insured by the admitted market, there's over 6 million homes insured by the admitted market. So we have a lot of progress to make on this space. I'm proud of what we've done so far, but I'm looking forward to hearing from fellow panelists on some things that we can do going forward, both in Tallahassee at the state level as well as in DC at the federal level, to help us close that protection gap, leveraging private market participation.
So I know the NAIC and FEMA have done a lot of education to tell people when you buy a standard homeowner's policy, flood is not included in that policy. Is that message resonating? Do people get it now that you have to buy private flood or buy flood?
So I still don't think so. I still don't think so. And I always think this is one of the things I'm most thankful for is that I was able to spend 2 years as an insurance agent in Florida before I became a regulator with the OAR. And I won't go into the background for time purposes, but suffice it to say that on my first day as an insurance agent, I knew less about insurance than anybody who walked in the door that day. And so I learned about the insurance market through the lens of the consumers that were coming in the door. And the conversations that I would have with individuals, and this was about 12 years ago, when we got to flood insurance, it was, you know what, the bank said that I don't need it. I just need to get through the home buying process. I'll call you in a few weeks about flood insurance. When you start talking about adding on coverage to what people consider a standard homeowners insurance policy, they think to themselves, this isn't included in the standard homeowners insurance policy and I'm not in a flood zone, so it can't be that important for me to have. And it's an extra couple $100 and I've got so many other things to deal with, and so off they go. And I really think there's a disconnect on an individual level for people that don't realize that flooding can happen to anywhere, no matter where you live. And the numbers support that when you look back at some of the more major floods that we've had and the percentage of those losses that have occurred outside of special hazard flood areas.
So Angela, I'll turn to you. So 25 years ago, after Hurricane Andrew, the major carriers in the U.S. decided Florida was too politically volatile and had too much weather volatility to continue to write in Florida. And then the Bermuda market really sprung up after Hurricane Andrew, and today represents about 60% of the reinsurance for hurricane risk in Florida. So what's the role of insurers and reinsurers, particularly the Bermuda market, for this new novelty of private flood that's really not new, it's revisited?
Yep. So after Katrina is when RenaissanceRe really started focusing on this. And it's something that at Ren we are really proud of because we've spent over a decade focusing on this, expanding out. And there was points where we didn't think anything was going to come of it, but we still kept forging ahead. So right after Katrina, first thing we did was we knew we had to understand the risk better. So we hired a hydrologist, as we all do. Then after that, we also focused our government engagement team on the NFIP reauthorization. So the reauthorization was coming up in 2007. It's supposed to reauthorize every 5 years. We won't talk about what's happened the past couple years. But in 2007, our main focus was to try to get the NFIP's premiums up a little bit higher because it was clear they did not have enough premiums to pay out their losses. We also wanted to create an opportunity for the private flood market. By actually increasing those premiums, it would actually give the private flood market an opportunity to start to compete against some of those NFIP policies and get that a little bit more. We wanted the NFIP to become financially stronger. To do that, one of the ways is obviously by purchasing reinsurance. And we also wanted the private market to be able to compete, which meant that the private market policy had to be the equivalent of an NFIP policy in the eyes of the bankers. So 2007 rolls around, we get one out of those three items, which is just a little bit of a bump up in the premiums. So 2008 comes around, RenaissanceRe decides we're going to double down. So we have been working at that stage with organizations like the RIA, ABIR, but we knew we had to increase the number of voices at the table and come to a greater common dialogue in order to try to push this forward. So we did a couple things. We created a coalition called Smarter, Safer. That was a group of like-minded individuals, not just in the insurance and reinsurance industry, that is trying to focus on the risk mitigation efforts in order to try to make the world a little bit safer and better. We also started running a risk mitigation leadership series, which we're now actually about to start our 14th one. And within that series, it was an opportunity to try to get academics, government, scientists, industry people together in order to actually just have the conversation about what it is that we're trying to solve with the flood industry, but also outside of the flood, hurricanes, earthquakes, everything going forward in order to try to get a little bit better at working together. So next reauthorization comes was about, and I'm going to move quickly because we are short of time, and I know I talk quickly. So 2012, that is what everybody knows as bigger waters. So at this point, we now, with the greater voices, we actually get additional increased revenues, but we also finally get the authorization for the NFIP to consider buying reinsurance. Won't go into all the details, but 4 years, reports, a lot of coordination, a lot of leadership from the NFIP. Lots of lawyers, modelers, reinsurers, brokers, all collaborated and tried to push that to the point where 4 years later they got their first reinsurance program over the line. So while all that was going on, we go back a couple of years to 2012 again, Sandy hits. So at this point, our hydrologists, we kind of pull them out of the woodwork from behind the scenes. We have what we think is this great view of flood risk that we haven't seen from any other organization in the U.S. at that stage, which is essentially an inundation map just a couple days after Sandy hit, so we could try to figure out where our flood exposures were and start to analyze them. So we go show this to Kevin O'Donnell, my CEO. Kevin, of course, does what we all do. Can you zoom in onto this one house, on the Jersey Shore, which just happened to be his in-laws' house? He was like, you don't have that as flooded, and it was flooded. Well, we went back, looked. We were using the exact same resolution of the USGS elevation data that everybody else in the industry was using, which was 10 and 30 meter resolution. That wasn't good enough. There was a little dip in the road, water went through there and flooded out an area that, because we didn't have the high resolution data, we didn't have the areas that were flooding in. That wasn't the only area, there were more areas than that. But why does that matter? Because as soon as you get 1 inch of water in your home, you could have losses up to $25,000. So if you get that elevation wrong, your losses could be severely under or overestimated. So the resolution of the elevation, as well as in the hydrology model, is so important in order to actually figure out what the risk level is and in order to price it out. So we get to the great work in Florida then in 2014. Private market starts to be able to write. We say, okay, we've got experience in the coastal area. We have a pretty good view of the hazard. No data from FEMA whatsoever on trying to figure out the severity. But we know, the only way we're going to get it at this stage is to actually start writing a policy. So we go where we know, which is coastal Florida, which mostly is exposed to the hurricanes, and severe, not severe tropical storms, but tropical storms. So we start writing there. A couple years later, we get some experience, Irma, Michael. We have now moved inland, and we now actually have what I think is a growing private market in Florida. We've started writing other policies as well, and it's something that we know we can actually at this point now replicate to other areas in areas where we can. A couple months ago, I was sitting there with about 200 and so agents that were all in Florida talking about what's actually happened in the flood market within that state. And one thing that became really clear is that we aren't the only ones doing this. There is a big market effort. One agent told me that he had 7 different private market policies that he was quoting at that time. And most of them were offering coverages that were above and beyond where FEMA was currently offering. So as an industry, I sat back, and that made me really proud to know that we have actually helped push that forward and make a difference.
So what kind of opportunity are we talking about? The most recent numbers have that Americans, about 41 million, are exposed to real flood risk. Right now, FEMA has about 6 million, between 5 and 6 million policies through the NFIP. So there's a huge opportunity here. But we have a question from the audience that FEMA also, and by the way, this is not derogatory to anyone that works at FEMA or NFIP, but they have many handcuffs on, many constraints because of their statutory structure. And one of those constraints is the rate methodology that comes out of the NFIP. So the question is, how do the proposed changes to how the NFIP sets premium affect the potential for private flood, which is really a risk rating 2.0. Mm-hmm. So I don't know, David or Angela, whoever wants to take it.
Do you want to go first, or I can go?
So I'll offer my thoughts, and then I'd love to hear yours. Yeah. So to me, I'll give the answer that always frustrates me when my actuaries give it to me is, well, it depends. And it depends, in Florida in particular, on the area of the state. there are some areas of the state, Tampa in particular on the West Coast and of course Southeast Florida, that are the disparity between the NFIP rates and what the private industry would need to charge in order to be competitive. It's just such a wide gap that there's a lot of work that needs to be done to closing that gap down. And honestly, when we look at how we close that gap down, one of the examples we look at is the great work that Barry has done at Citizens in depopulating Citizens, because we always hear this notion when it comes to rates of cherry picking. And so when we're talking with our counterparts in DC and even a couple members of the Florida legislature about private market participation, well, how can you assure us, Commissioner, that the private industry is not going to come in and pluck out all the really good risk and get that premium and then leave all the bad risk in the NFIP? And what we think is that when we looked at Citizens back in 2010, 2011, right before we had this high level of takeout activity, we looked at blocks of business and Citizens, and I think, I won't speak for Barry, but I think that they did too. And they identified blocks of business that they said, you know what, this probably isn't going anywhere. This risk is actual residual market risk, and it's where it needs to be. So our private industry took out risk that shouldn't have been in Citizens, and we very quickly saw a plummet in that policy count. As a byproduct of that, our domestic industry suddenly became much more diversified around the state. Many of them began to diversify around the southeastern United States and the northeastern United States, and they had a well-diversified book of business, and a surprising thing happened, which frankly shouldn't have been surprising. They came back to us and they said, now that we're so diversified, that risk that we didn't think was attractive back then, we now think we can responsibly write it at rates that are lower than what we thought we could have written it back then. So when I look at a question like this, I think one of the things that will help in high-risk flood areas like the Tampa region, like the Miami region, is as we see more private carriers start to underwrite responsible products around Florida and around the United States, they'll come back to some of these areas, regardless of how NFIP sets their rates, and say our rates would have needed to be up here way back then when we were still a developing market. Now we can bring them down here because we've diversified our book of business so effectively around the nation and hopefully even the world. But.
Yep. So I will agree with all that, and I'll expand a little bit as well. So there are definitely risks that we are never going to be able to put on a private market balance sheet because we just can't get the premium for them, and no one will buy the policy. So those, in my estimation, will always stay, within the NFIP, and hopefully they will get some risk mitigation help through various different forms that can actually help them with that. When it comes to risk rating 2.0, this actually gets to the next question really about expansion as well past Florida. So risk rating 2.0 is trying to move where most of the prices for the private flood market is going, which is to a more model-based analysis and a premium based off of model. Now, if you are a non-admitted company, then you can easily, take whatever model you want, come up with the rates, and you can easily compete. And the private market will always, and should always, be able to provide better coverage, higher limits, because the NFIP is regulated by the government about what they can provide, and they're never going to be able to get up to the gold standard that can be provided by the private market. However, we were going to be limited on the admitted basis by certain states when it comes to expansion outside of Florida. And that is because right now there are certain states that do not allow cat models to actually be used for rate making. There are certain states that even when they actually allow the use of cat models, they want the information to become public knowledge. That's never going to happen. This is how the cat modeling companies make money, and you just can't really see even just a flood map out there because that's just their IP out the window. Then you get to the effect of climate change, which we were talking a little bit about last night. So there is one thing that we can all put down and say, we know that flood risk is more and higher than what it was 25, 50, 100 years ago. So if you are looking at a historical record of hurricanes and tropical storms, and you're trying to actually figure out what the inundation was within those events to calibrate your model to today's, we know that you will underestimate that risk if you are using the 1926 Great Miami Hurricane and you still have just a couple of inches of flood. It's going to be greater today. And until you can actually allow a climate change model approved for an individual risk rating on an admitted basis, the private market will struggle to keep up with the NFIP because the NFIP will be allowed to because they don't follow state regulations.
So Barry, we have to get you in the mix here. So tell us about Citizens, how you did it and why you did it, of depopulating and pushing to the private market. You're the poster child for how this could work.
Yeah, thanks, John. So I think, as David indicated, back in 2011, 2012, Florida was really in crisis. Every major carrier in the country with capital had left the marketplace, so it was really an emerging Florida domestic market. We had 23% of the entire market, that's $512 billion worth of exposure. And the real issue that we were trying to address is that we're funded by assessments. So we had over 11, if an Andrew would have hit in 2011, we would have been assessing Floridians $11 billion based upon a $24 billion PML. So the charge really that we were given is, how do we move this business out into the private market? We were a $3.2 billion company in an $11 billion residential market. And the secret, unfortunately, NFIP doesn't have this advantage, but the secret really was making all of the data available to the private market. So we literally opened the doors, so any company that wanted to participate, any current company that wanted to participate, literally could come in. They could access all of our data. So that was step number one. So we gave every single risk characteristic that we had. So that was opportunity for both Florida domestics and for new capital entering the market. Step number two is to remove every single obstacle. And if I came to you and I said, look, I've got $3 billion worth of business, and I can give it to you with zero acquisition cost. Zero. Not only that, I will provide the servicing of that business for a period of time until you're ready to accept that business. And that's what we did. We literally eliminated any ceding commission associated with the removal of the business. We provided servicing capability for the current Florida domestic carriers who wanted to assume the business. And then we picked up really went out and really talked to investor groups that wanted to apply capital and bring capital into Florida. And with David's, with the commissioner's help, we had a surge of new formations in Florida. Now, it didn't hurt that 13, 14, and 15 were the most profitable years in Florida. That was an $800 million profit, $800 million profit, $650 million profit. So the bottom line is we just literally opened it up, and then we aggressively went out to companies and said, look, we'll bring you in, we'll take a look at your strategy, what you want to write, what your risk appetite is, and we will sit down with you, we'll match our portfolio to what you want to write. I have to admit, in my 49 years in this business, I'm 2 years short. In my 49 years, this is the first time I've tried to give away business as opposed to writing it. So it's a very, very different, model. But it's quite an exercise. And obviously, the success, as David indicated, is we've gone from 23% of the market down to 4% of the market. We're down to $108 billion in exposure, about 20% of what we had. And we believe, it was actually in Washington 2 of the last 3 years, really, as David was indicating, trying to show how components of the Citizens model can be applied to NFIP. One of the key issues is sharing data, right? I mean, if you really want to move the bar down for NFIP, and if that data could be made accessible to private companies, then the risk selection, opportunities and the ability of these companies to match what their risk appetite is with the NFIP portfolio would exist in the same way that it existed in the Citizen situation.
So hopefully this has given you a little bit of a snapshot, but when you see me tweet #ProtectionGap, #de-risking government, hashtag climate risk, you are seeing what this story is unfolding with great opportunity, not only for insurers and reinsurers, but great opportunity for consumers. We're going to open it up and see if there are any questions on the floor real fast. We're, I think, a minute over, but we tried to keep it on schedule. Any questions on the floor? If not, I'll just open it up for any closing comments of transferring this risk and any thoughts of what else we can do to replicate some of the Florida success to other states. Barry, you want to start with you?
John, I know we were talking about this last night, but to me, the biggest opportunity is really consolidating product. We have companies now that are offering flood, as an endorsement to the homeowner's product. And if the requirements are established that they must have flood, and if the control is similar to what is required, by mortgagees in the residential property area, then I think that would open up, the market. But I truly believe a consolidated product that really offers the opportunity, and there are companies that are doing it, as you know, in Florida today. Really incorporating that flood product with the residential product, I think really opens up, flood to a whole new world.
Mm-hmm. All perils policy. David, what do you think?
So I think I would agree with everything Barry said, so I won't repeat it. I'll just add to it. Risk diversification is really important to our marketplace. We need our domestic carriers to be able to write this risk responsibly. And that means that they need to have a strong and robust reinsurance market to tap into, and that's why the Bermuda reinsurance market is so critical to the success of a private flood insurance market in our state. So I would just encourage you and invite you, as you see hurdles that are prohibiting you from really expanding your horizons in that space, strongly encourage you to reach out to us so that we can partner together to look for ways that we can increase that space and lower that protection gap.
Angela, the last word before we get the hook.
Excellent. So the protection gap is something that as an industry we were all very focused on. It is increasing. We have more uninsured risk in this world, and it's not just, in the developing world, it's also within the U.S. In order to solve this, we can't do it alone. We all have to work together. We have to figure out how to ensure not just the typical homes and businesses that we have on our balance sheet now, but to actually how to expand that. And that might not just be the homes and the businesses. It might be looking at the communities, the risk transfer mechanisms that we actually haven't thought about before, but will help these communities rebound after the event so they're stronger and everybody can get back to work.
Great. Please join me in thanking our panel.